This video will provide a walkthrough to the solution for exercise 1212, which focuses on accounting for bonds under both IFRS and ASPE. Here's the data for our problem. On January 1st, 2025, Hobart Services issued $200,000 of 7% bonds at 98. The bonds are due on January 1st, 2030, with interest payable semi-annually on July 1st and January 1st. There are 5 requirements for this problem. Let's start with requirement A, which asks us to prepare all the journal entries relating to the bond for 2025, assuming that Hobart follows IFRS. So to record the issuance of a bond, the company is going to debit cash and credit bonds payable for the present value of the future cash flows. In this case, we're told that the bond is trading or selling at 98, which means that it's trading or selling at 98% of its face value. That is the present value. So we'll take the face value of $200,000 times 0.98 or 98% to end up with $196,000. That's the amount that will credit to cash and debit to bonds payable. If we want to determine the actual yield for this using our calculator, if we input 10N, because this is a 5-year bond with semi-annual coupon payments, so 10N, we'll enter 196,000, press the plus minus button, and then PV. For the payment, we've got $200,000 in bonds times the 7% coupon divided by 2, so that's $7,000. Press PMT, and then enter 200,000 and press FV. And now compute IY, and we end up with an interest yield of 3.74%. This is a rounded number, but your calculator keeps that number to the exact digits. Now we need that number in order to calculate what the interest expense is going to be in subsequent payments. So for the payment on July 1st, we'll debit interest expense in the amount of $196,000, which is the balance of the bond, times a 3.74% yield, to give us interest expense of $7,330. Again, that's a rounded number. If we use our calculator to save us some time, we use the amortization feature by pressing the second function key and then PV, where you see above that it says amort. For P1, we want that to equal 1, so type 1 and press enter. Press the down arrow. For P2, we also want that to be equal to 1, so type 1 and press enter. And then if you press the down arrow until you see INT, that's the interest expense. And the exact number is $7,337.15, which is $7 off the rounded number, because if we do this manually, we're using a rounded number for the yield of 3.74, and the exact amount is a little bit different. We'll skip a space, and the cash coupon payment is going to be the $200,000 times a 3.5% coupon, which is a 7% annual coupon divided by 2, that's $7,000. The difference between the interest expense and the cash is $330 for a journal entry to balance. That'll be a credit to bond payable, which is equivalent to the amortization of the discount, because this bond was issued at a discount, since its present value of $196,000 is less than $200,000. Using the amortization feature with P1 and P2 both equal to 1, if you scroll down to where you see PRN, the exact number is $337.15. The next entry in the year 2025 will be at December 31st, where we have to record the accrual of interest on the bond, even though the payment is on January 1st. So we're going to debit interest expense for $7,343, calculated as the original $196,000 balance on the bond, plus the $330 discount amortization, multiply that sum by 3.74%. That gives us $7,343. Using the amortization function in the calculator, if we now set P1 and P2 both equal to 2 and scroll down until we see PRN, we end up with a value of $349.77, which is about $6 off. And interest, INT, has an exact value of $7,349.77, which is again $6 off because of the rounding in the yield rate used in manual calculations. For requirement B, we're asked to prepare a classified partial statement of financial position as at December 31st, 2025. So if we did a full amortization table for this, you can see that the balance owing at December 31st, 2025 is $196,673.16. Using the amortization function in the calculator with P1 and P2 both set to 2, the balance is $196,687, which is just a few dollars off the amount in the amortization table, which is based on a rounded market interest rate of 3.74%. So for the partial statement of financial position, under current liabilities, we're going to have the interest payable of $7,000, which was accrued at December 31st. And then for long-term liabilities, a long-term bond, 7% due January 1st, 2030, with a carrying value of $196,673. As you can see from the amortization table, with each payment, that discount is slowly going to be amortized to bring the balance of the bond up to its $200,000 face value by the time the bond matures. For requirement C, we're asked to prepare the entries for 2025, but assuming now that Hobart Services follows ASPE and uses the straight line method to amortize any premium or discounts. The straight line method can be used only under ASPE and not under IFRS. So on January 1st, the entry to record the bond is the same both under ASPE and IFRS. The company will debit cash and credit bond payable for $196,000, which is the $200,000 bond trading at 98. To record the interest on the first payment, the easy item to record here is the $7,000 cash payment. So let's credit cash for $7,000. Then what we want to do with the straight line method is actually calculate how much of the bond discount is going to be amortized. So what we'll do is we'll take the $200,000 par value or face value of the bond and subtract the $196,000 present value. That amount is $4,000 and represents the amount of the discount off the bond. If we divide that by 10 payments, that means that each payment will include discount amortization of $400. So we'll credit the bond payable for the $400 discount, and then the interest expense is simply the amount that'll make our journal entry balance. We'll take the $7,000 coupon payment plus the $400 discount amortization, and that gives us $7,400 in interest expense. So we'll debit interest expense for $7,400. At December 31st, the entry is almost exactly the same with one small difference. Both the interest expense and bond payable values will be the same for every entry. $7,400 as a debit to interest expense and $400 to the bond payable. However, because the payment actually occurs on January 1st, instead of crediting cash for $7,000, we have to credit an interest payable account for $7,000 instead. And on January 1st, that $7,000 interest payable will be debited and then cash credited. Next, on to requirement D, where based on the data in Part C, we're asked to prepare a classified partial balance sheet as at December 31st, 2025. So this is going to be under the straight line method. So just like under IFRS, the company will have a current liability for interest payable of $7,000. The only difference now is that for the long-term liability, the carrying value of the bond is going to be slightly different. So if we completed a full amortization table of this bond from the balance of $196,000 to maturity, you can see here that the amortization of the discount is $400 every payment and the interest is $7,400 every payment. Looking at the line for the payment on January 1st, 2026, we see that the balance is $196,800, and that's actually the same thing as the balance at December 31st because of the accrual that has to happen the day before the payment. So the balance on the bond at that point is $196,800, and that's what we'll see on the balance sheet. And last, on to requirement E, where we're asked, will the total cost of borrowing over the life of the bond using the effective interest rate method be higher, lower, or the same as the total cost of borrowing using the straight line method under ASPE? Well, as it happens, regardless of whether the company uses the effective interest rate method or straight line method, the total cost of borrowing will be the same for both methods, and that's a total of $74,000 in interest. The only difference is that the pattern of recognition will be different between the two methods, as illustrated in the amortization schedules, where with the effective interest rate method, the interest starts at July 1st, 2025 at $7,330 and increases over time to $7,540 by the last payment, as compared to a flat $7,400 in interest with each payment under straight line amortization with ASPE. And that's it. We've solved this problem.